Jason Pride is Director of Investment Strategy at Glenmede Investments, which manages almost $20 billion. Jason joined us from Philadelphia this morning. Jason, welcome to In Business, and you're finding returns Thanks for joining us. You like high-yield bonds right now, including those of sovereigns. Which country's debt are you buying?
Look, it's kind of a broad approach, but we are heavily invested in Asian sovereigns. Basically, the bottom line story that we're seeing here is that the developed markets are laden with debt at the sovereign level. They are going through a lot of fits and starts in the process, and there's a lot of questions sitting out there, particularly in Europe. The interesting scenario about this environment is that that emerging markets are in a much different fiscal and debt situation. Their debt balances are lower, their fiscal balances are better, their consumers are in better shape, and their economies are in better shape. So we find that to be an interesting place to hide and actually find long-term returns, as opposed to sacrificing them and buying things like Treasuries yielding 2% on the 10-year.
Yielding 1.923% right now on the 10-year. It's amazing to see such a record low returns, Jason. But I mean, what's your allocation there? How do you break up on equities versus high-yield bonds?
I mean, look, we've taken an approach that we want to be defensive, but we don't want to forfeit the long-term returns. So, the easiest thing to do right now is to get scared, to forfeit your long-term returns, and to hide in gold on one hand and Treasuries on the other hand. We think that's a mistake for the longer-term investor. Having said that, we don't want to take the full risk of equities at the same time. So we've taken an approach of balancing the portfolio, stretching it out, taking away from equities, but placing our investments across the board in other risk assets or more moderate risk assets, high-yield debt, sovereign debt. We've used a larger alternatives exposure. We've used things like commodities, and we've used even more conservative equities within the equity portfolio. So we're well underexposed to equity market fluctuations, but we're still taking risk and not giving up long-term return by investing in what we consider to be the ludicrous points of the market, the Treasuries and the gold aspects.
And Jason, when you are judging risk and how much you're willing to take on, what is the prime gauge of that for you? Is it LIBOR, lending rates?
So there's two things that we're looking at right now as far as technical aspects to gauge risk. We're looking at Euribor spread. So Euribor is a Europe-wide interbank lending spread. You can compare it to overnight interest rate swaps, which is basically a policy rate, and see how wide that is. That's currently in excess of 80 basis points. Those are the sort of levels that we saw prior to the Lehman collapse. And obviously the Lehman collapse in 08 shot it out much further, up into the 200 basis points range. But it indicates stress in the European banking system. It indicates a lack of willingness for banks to lend to each other. And, we don't have perfect connections into everything that's sitting on every bank's balance sheet. But I can tell you, if the banks in Europe are worried about lending to each other, they probably know something that hasn't gotten out to the rest of the market. And that's why we continue to see this increased or this heightened stress. The second thing we're looking at is just economic leading indicators, which continue to point downward and have yet to show some meaningful signs of stabilization or upward trend at this point in time. It's basically down to European stress and economic growth coming in at a soft patch.
Is there any way you would buy a bank stock right now?
U.S. banks are actually relatively well capitalized, and depending on what you're looking at, you can definitely find some interesting opportunities in the U.S. In Europe, I continue to believe that the European banking system is relatively undercapitalized. They're going to have to go through capital raises. There's no way you can predict the price at which the capital raises are going to be done. And therefore, in our financial weighting in Europe, we're actually hiding, or at least the managers that we're using are hiding basically in the insurance area, where you don't have quite the same sort of liquidity problems that you do in the banking area.
So you think European insurance companies you would never see an AIG type scenario? You think they're insulated from a meltdown?
They're not completely insulated, but what they are insulated against is a liquidity run to the degree that banking systems could have. Banking systems have a depository base that can disappear overnight and is only backed up by the ECB. Insurance companies tend to be longer term in nature in their borrowings. They tend to refinance less frequently. They're still participating, so they're not insulated completely, but they're definitely more protected.
You're also investing in auction-based strategies. Explain what that means.
I'm sorry?
I'm looking at your strategy note here, and it says that you're investing in auction-based strategies right now. Explain
I apologize. I didn't hear you there. So option-based strategies for us is a secured options portfolio, what you would typically call a covered call portfolio. This is an equity portfolio where you're selling calls regularly against it on a monthly basis in order to generate income from selling those call options. It's a way to participate in long-term equity returns while collecting a fixed income-like premium over the meantime, and that actually protects you about 1% to 2% per month versus the downside.
All right, Jason Pride of Glenmede, thanks for making time.